Hello traders. In this video, I'm going to share a volume trading strategy that will change the way you trade. And if you like to read about the same strategy, then a detailed article is also present on our vlog page and the links are available in the video description. Make sure you read it once as it will clear all your doubts. So let's move on and dive into the world of trading. Volume plays a very important role in technical analysis as it helps us to confirm trends and candlestick pattern. Consider volume as a tool to collect information about how other traders are acting in the market. Volume indicates how many shares are bought and sold over a given period of time. The more active the share, the higher would be its volume. For example, you decided to buy 100 shares of Tesla at $1,000 each, and I decided to sell 100 shares of Tesla at $1,000 each. There is a price and quantity match which results in a trade. You and I together have created a volume of 100 shares. Many traders have this misconception that the volume will be 200, which is wrong. The actual volume will be 100 only. Now let's understand how volume adds up on a typical trading day. So the market opened at 9:30 a.m. and there were 400 shares exchanged at the price of 62.20. An hour later, 500 shares were traded at 62.75. At 10:30 a.m. if you were to check the total volume for the day, it would be 900. Likewise, 350 shares at 63.10 were traded at 11:30 a.m. and up to 11:30 a.m. the volume was 1250. So on and so forth. The total volume information that you see here is called cumulative volume, meaning at 3:30 p.m. a total of 3,300 shares were traded at various price points ranging from 62.20 to 64.50 and the entire trading session. Now, let's move on to the volume trend table. Volume information on its own is quite useless. For example, let's assume that the cumulative stock volume for Tesla is 90,000 shares, which means on a single trading day, 90,000 shares of Tesla were traded. So, how useful is this information to us when we read it in isolation? Well, it is of no use to us and hence would mean nothing. However, when we associate this volume information with the preceding price and volume trend, then this information becomes meaningful to us. Now let's understand the basic idea on how to use volume information. To simplify the concept, I'm going to use daily candlestick as my time frame while explaining the concept here. So if you are using different time frame, then you can apply it accordingly. So the first line in the table says when the price increases along with an increase in volume, the expectations are bullish. But before we understand this table in detail, think about this. We are talking about an increase in the volume. But what does this mean? What is the reference point here? Who are we comparing it to? So as a practice, we should compare today's volume over the average of the last 10 days volume. Generally, the rule of thumb for us will be very simple. High volume days are the ones when the present volume is greater than the last 10 days average volume. Low volume days are the ones when the present volume is lower than the last 10 days average volume. And when the volume is approximately the same as the last 10 days average, then we'll say it's an average volume day. Now, in the given chart, you can see that the volumes are represented at the bottom of the chart. as you notice, all the bars that are bigger shows an increased volume, and we can say that some institutional activity or large participations has taken place. Now let's understand the psychology behind the volume trend table. When institutional investor buys or sell, they do not transact in small chunks. For example, if institutional investor would buy shares of Tesla, would you think they would buy 50 shares? Well, no, they would probably buy 10,000 shares or even more. And if they were to buy 10,000 shares from the open market, it would start reflecting in volumes. Besides, because they are buying a large chunks of shares, the share price also tends to go up. Usually, institutional money is referred to as smart money. It is known that smart money always makes wiser move in the market than retail traders. Hence, following smart money seems like a good idea. If both the price and the volume are increasing, this only means one thing. A big player is showing interest in the stock. Going by the assumption that the smart money always makes smart choices, the expectation turns bullish, and hence one should look at buying opportunities in the stock. So, whenever you decide to buy, ensure that the volume are substantial. This means that you are buying along with smart money. This is exactly what the first row in the volume trend table indicates. Expectation turns bullish when both the price and volume increases. But what do you think happens when the price increases but the volume decreases as indicated in the second row? Now think about this in the following term. Why is the price increasing? Well, because market participants are buying. Are there any institutional buyers associated with the price increase? Well, no. Well, how can you know that there is no meaningful purchase by the institutional investor? Well, the answer is simple. If they were buying, then the volumes would have increased and not decreased. So, what does a price increase associated with a decreasing volume indicates? It means the price is increasing because of small retail participation and not influential buying. Hence, it would help if you were cautious, as this could be a possible bull trap. Now going forward, the third row says a decrease in price along with an increase in volume sets a bearish expectation. Let's understand it with the psychology. A price decrease indicates that the market participants are selling the stock. An increase in volume indicates the presence of smart money. Both events occurring together imply that smart money is selling stocks. Going by the assumption that smart money always makes smart choices, the expectations is bearish, and hence one should look at selling opportunities in the stock. So, whenever you decide to sell, ensure that these volumes are good. This means that you too are selling along with the smart money. Now, moving forward, what do you think happens when both volume and price decrease as indicated in the fourth row? Think about it in the following terms. Why is the price decreasing? Because market participants are selling. Are there any institutional sellers associated with the price decrease? Well, no. Well, how would you know that there are no meaningful sell orders by institutional investor? Because if they were selling, then the volume would be increasing and not decreasing. So, what does a price decrease associated with decreasing volume indicates? It means the price decrease because of small retail participation and not influential selling. Hence, it would help if you were cautious, as this could be a possible bear trap. Now, let's understand this with one example. The occurrence of a bearish engulfing pattern. This suggests a short trade for reasons discussed previously. A resistance zone around the high of a bearish engulfing candlestick pattern, and we all know that resistance indicates supply. Therefore, the occurrence of a bearish engulfing pattern near the resistance area suggests there is indeed a strong supply for the stock, and hence the trader can look at selling the stock. Now, engulfing candlestick pattern on the resistance zone with high volume. What can you expect from this? The conclusion is quite clear. High volume and a price decrease confirm the presence of large influential market participants who are positioning themselves to sell the stock. All three independent variables, that is candlestick pattern, support and resistance level, and volumes, suggest taking the same action, that is to go short, because this is a triple confirmation. Now let's summarize this whole video and understand how we can apply this knowledge in the real market. So the checklist is as follows. The stock should form a good candlestick pattern on a good support or resistance zone. For a long trade, the low of pattern should be around the support. For a short trade, the high of the pattern should be around the resistance. Volume should confirm the trade. Presence of above average volume on both buy and sell days are mandatory. Understand one thing, low volumes are a big danger, and hence don't trade with this strategy when the volumes are low. So that's it for today. Thanks for watching. If you have any doubt, let me know in the comment section. I'll see you in the next video. Till then, keep trading, keep working hard. Good day.